And so what I think is going to happen is it's going to be clear that they haven't landed the plane. It's going to be clear that inflation is still with us to a degree, maybe not to the 9% area, but in the 3 or 4% area. And that's, and then ultimately we're going to have a monetary problem driven by the math that I just described about the fiscal situation. And that's going to lead the bond market to sell off hard, or something will break, as it did with Silicon Valley Bank, and the Fed will have to come in with the monetary fire hoses and do the one thing they do really well, which is print money. And at that point in time, gold starts its next leg up, and in this cycle, I can see it going to 3,000, 4,000, 5,000, higher.
After several months of consistent and often successive interest rate hikes, the U.S. Federal Reserve announced a policy reversal in September, cutting its Fed funds rate for the first time in 4 years. The consensus among Federal Open Market Committee members is that the inflation battle has been won, and the U.S. economy is out of the woods. However, renowned economists and financial analysts warn that inflation has become sticky, and the Fed has to take more urgent measures to get the economy back on track. Larry Lepard, an investment manager, sound money advocate, and gold stock fund manager, points at several underlying issues, particularly those stemming from the unsustainable trajectory of the U.S. national debt, which recently hit $36 trillion. Lepard argues that we are nearing the final stages of the fiat monetary system, a structure he believes is irreparably broken due to decades of reckless government spending and unchecked borrowing. He has long warned of the dangers posed by this financial recklessness, which has led to the steady devaluation of fiat currencies like the US dollar. According to Lepard, the system is crumbling from the inside out, weighed down by its reliance on inflationary practices that erode the currency's purchasing power. In contrast, Lepard points to hard assets like gold and silver as the antithesis of fiat money. Unlike currencies that can be endlessly printed, these tangible assets are finite and cannot be created at will. Their intrinsic value and scarcity make them immune to the inflationary pressures plaguing fiat currencies. For Lepard, these qualities underscore the importance of hard assets in an era where the fiat system is rapidly losing credibility. He believes that as confidence in fiat currencies diminishes, there will be a significant shift toward gold and silver as the preferred vehicles for preserving wealth. We will bring you key highlights from Lepard's recent interview with Investing News, where he delves deep into the unraveling of the fiat monetary system and the opportunities in hard assets like gold and silver. But before we dive in, we'd greatly appreciate it if you could take a moment to like this video, subscribe to our channel, and turn on post notifications so you never miss valuable insights like these. Your support helps us continue delivering quality content. Now, let's get into the interview. Enjoy.
The cracks that I am seeing is that while they, and this is the pattern of the Fed, they tend to break things and then they do emergency measures and get things back under control, and then they break again. And so the last thing they broke the no inflation, conditions that they had pre-COVID. And, COVID came along, they grew the money supply 40%, and suddenly we had 9% inflation. It was raging. And they realized they'd overshot on the money printing and they'd been too loose for too long. They were still doing QE and buying bonds late into the, once inflation was already going, they were claiming it was transitory. It wasn't. Then they tightened like crazy and they sent everything in the other direction. And so that's the regime we're in now, where they have brought inflation down, not to what they hoped to bring it down to. They hope to bring it to 2 or below. They're not there yet. They're in the 3s. And there's some indications that it's maybe starting to turn back up, but whatever. What I see that the bigger problem that I think the Fed has is actually more at the United States federal government fiscal level. And this is what happened just in a nutshell. When COVID came along, federal government spending really went up. I gave a presentation at the show earlier, and that's available on my X feed, that shows a chart which shows that pre-COVID the government was spending about $4 trillion a year. COVID came along and that suddenly went up to 6.5. Really, really rapid expenditure growth, obviously to counter a pandemic and an emergency. But the thing is, when the pandemic was over, you would have thought it might come back down, and it didn't. It stayed high. In fact, it's gone up. This year was just 6.75 trillion. And in an economy where the stock market is at record highs, employment has recovered from the COVID dip, inflation has come back down a bit, we are still running very big deficits. Last year's deficit was 1.8 trillion. And with the last 6 months annualized, the deficit's now 2.4 trillion. And so the problem there is that adds to the debt. And so the debt is growing very rapidly. We just crossed 36 trillion. And the problem with that is that with these higher interest rates that they put in place to beat inflation, suddenly the federal government interest expense has gone straight up. And so there's also in my presentation a chart, and most people have seen this chart, that shows U.S. federal government interest expense for the last 15 years. And it kind of trends nicely, slowly up, and then suddenly it just goes vertical. And so we are now spending about $1.2 trillion a year on interest. It's more than we spend on defense. It's almost as much as we spend on Social Security. The interest on the debt has really caused the fiscal problem. And so what that then leads to, the follow-on knock-on effect of that, is what I call a fiscal doom loop, or other people call it fiscal dominance. A lot of ways of looking at it, but it's pretty simple. Your interest cost is higher, so it's a bigger number. That bigger number goes into the budget. Your tax revenues haven't gone up that much, therefore your deficit is bigger. How do you take care of the deficit? You sell bonds in order to fund the deficit. Well, the bonds go into the market for interest rates. Same amount of demand for interest rates, more supply of bonds. Oh, how do you solve that? Interest rates go up. Oh, but interest rates go up means the government's interest cost goes up. Deficit gets bigger, and rinse, wash, repeat. So it's I call it a doom loop. It's a vicious circle in the wrong direction, which I believe will ultimately lead to the government having to say, okay, this isn't going to work. We are going to institute yield curve control or QE, or we're going to buy the bonds, because they're having a hard time finding people to buy the bonds. A lot of the bond auctions have been weak, and the government, foreign governments and foreign people aren't buying the bonds the way they used to. Net foreign buying has gone down consistently since 2014. That's 10 years of a downward trend of foreigners buying our bonds. And, we're going to pretty soon find that we're kind of like a third world country. And what this is, put in personal terms, this is like somebody who has too much credit card debt, and they are having a hard time making the interest payments, the minimum payments, so they go get another card, and then they draw on that, and they use that to make the minimum payments on the other, and then when that gets bigger, they go get another card. And it's just, you're borrowing to pay off the interest on what you've already borrowed, and it just can't go on forever. I mean, I define that as Stein's law, which is if something can't go on forever, it's going to end. And it appears to me like this is getting to the point where it's kind of getting critical. And I think, you've even had some pretty large, high-profile, establishment people say, we've got a fiscal problem here. So then that begs the question of what are they going to do about it, and that's a whole other question. I wrestle with that. First of all, nobody knows, right? Nobody knows. But I will make a couple of observations. It appears to be getting more and more critical. The lines are getting steeper, on the debt and on the interest. And they're compounding, and so that, I would say it's getting worse. And so I feel like this problem or crisis is going to come to a head in the next couple of years. They're pretty good at can kicking, so I'm totally willing to accept the possibility that, we're now in 2024, and I'm, thinking of this in fourth turning terms. Maybe it stretches out to 2030. Maybe it's another 5 or 6 years. I just don't see it going much beyond that. I think and it's really, Charlotte, it's actually really just kind of the math. When you kind of, when you grow, when you compound, I don't think people understand the way compounding works. And so when you compound your debt and you compound your interest, it's really hard to get out of the trap. Go back to the credit card, the family with the credit cards. Generally the way that gets resolved is they file bankruptcy, and start over again. Maybe the U.S. is going to go bankrupt. That's extreme. There has to be something very radical that takes place to restructure it and fix it. A very visionary leader with a ton of courage could maybe pull that off, but even that leader, the people would scream and yell. And so my sense is what will unfortunately happen is we will just keep running down this road, and we will have higher and higher and higher inflation, perhaps even something looking close to hyperinflation. And at that point in time, it will be so bad and so painful, and everyone will be so mad that they'll say, okay, I don't care how much pain it's going to take. We got to fix this goddamn thing. And I'm willing to get sober. Do you know what I mean? And so let's go back to sound money, even if the first year of it is awful. What we're living in right now is pretty awful too. So you see what I'm saying? So that's kind of how I think it gets solved.
Lepard foresees an imminent financial reckoning he terms the big print, where the Federal Reserve will have no choice but to print tens of trillions of dollars to stave off economic collapse. This dramatic intervention, Lepard believes, will stem from the unsustainable trajectory of the U.S. national debt, which he argues has reached a point where traditional repayment is impossible. He suggests that rising interest rates and ballooning deficits will push the government to a breaking point, necessitating massive monetary expansion to service obligations and stabilize the economy. According to Lepard, this crisis is the result of decades of fiscal irresponsibility, where excessive spending combined with the flexibility of fiat currency systems allowed debt to spiral unchecked. The Federal Reserve, he contends, has limited tools left, and inflating the debt away is the only politically acceptable path forward. However, such a move would come at great cost, further debasing the US dollar, stoking inflation, and undermining public confidence in fiat currencies. In this scenario, Lepard emphasizes the strategic importance of hard assets like gold and silver. Their scarcity and immunity to monetary manipulation position them as reliable stores of value during periods of rapid dollar devaluation. He predicts that as trust in fiat diminishes, individuals and institutions will increasingly turn to these assets to safeguard their wealth, catalyzing a significant shift in the financial landscape. Lepard is particularly bullish on gold, which he says could rise as high as $5,000 per ounce in the very near future. Let's get back to the video, as Lepard shares his outlook for gold, silver, and gold stocks.
I mean, it's kind of unlimited. The price of gold is inversely correlated with how much money they print. If they stop printing money, gold doesn't go up. But when they print money, gold goes up. And they're going to have to, but in the math we talked about earlier suggests they're going to have to print a lot of money. Now, they haven't done it yet, but it's coming, in my view.
Yeah. Okay. So, do you include silver in this?
Oh, absolutely. Yeah. So gold and silver track the same. I mean, silver is kind of like the wild child of gold. As you know, it's a fraction of the market size of gold, and it doesn't have the big stock out there. It gets used, and which is why it's more volatile. When there's a shortage of it, the price goes much harder and faster. There's a big underlying stock of gold, and so there's not as likely to be a quote-unquote shortage. But yes, I mean, typically, as we all know from studying these things in the past, when you have a bull market in precious metals, silver vastly outperforms gold. And so I'm very bulled up and excited about silver, and my fund is focused on a lot of the silver miners for just that reason. And I expect gold, in a year to let's say it's 3,500, kind of conservatively. I think silver is going to break through 50, probably be $75 or $100 within a year or two. So, which is as a multiple, when it's at 30 now, that's a much higher multiple than the growth in gold. So yeah, they're related. And but silver, just as we'll get to Bitcoin, but silver's more volatile than gold, right? I mean, there's a price to pay. Okay, so silver could outperform gold. Great. Yeah, that's the good news. The bad news is it goes down faster than gold too. So because it's not the same thing. So
Right, and let's go back to you're mentioning the gold stocks. Why are they not all in?
Yeah. So, well, I think there are two things. And these were made on the panel yesterday. And the guy next to me made a very good point. And I agree with him, which is one, the Magnificent Seven and the U.S. stock market at record highs have kind of been sucking the oxygen out of the room. So the average investor, if you own Apple, you own all those other, stocks, you own the NASDAQ, the triple Qs, you've done pretty well for, the last 10, 15 years. And, you're going to stick with it. It's kind of like, this is working. Why should I leave? And, NVIDIA, I mean, good God, there have been some killer stocks, right? So that's one. So people don't think they're doing anything wrong, even though all those stocks are at record valuations. And I think are at very great risk of eventually entering a bear market. I'd say the second thing is, that the gold stocks, it's a spread business where you're making the difference between the price of gold and your cost of mining. Cost of mining is your what they call your ASIC, your average sustaining cost to pull an ounce out of the ground. And that's going up with inflation pretty consistently every year. ASICs used to be, a few years ago, they were $1,000 an ounce. Now they're $1,400 an ounce. And in 5 years, they'll probably be $1,800 or $1,900 an ounce. So you need higher gold prices to keep your margins the same. And I think what's going on is as I said earlier, I think a lot of people kind of believe that this 25, 6, 700 price, it's an anomaly. I'm seeing a lot of models out of Toronto and other places we're going back to 2100. You get on Bloomberg and you Google analyst consensus estimate for 5-year out gold prices, it's like 20. It's like 2000, or maybe 2100. Well, guys, I mean, 5 years out, I think gold's going to be 4,000. So, and I think as a result of that, people are saying to themselves, well, these stocks, you know, if gold goes back down and we know there's inflation, so their mining costs are going to go up, their margins are going to be shrinking, why should I own them? And so what needs to happen is we need to have that psychological shift where people go, oh, you know what? Gold's not going back down. In fact, gold's going up. In fact, gold's going up a lot. And these margins are, you know, and yeah, there'll be 10% inflation in the ASICs, but guess what? You know, the price of gold is going to go up more than 10% a year. So the margins are going to be growing. And then suddenly everybody will be discounting and building models on $3,500 gold. And I can assure you, I mean, my companies that I've invested in, you know, they were doing well at 2070. They're doing great at $2,500 or $2,600 gold. And I mean, they'll be just coining and minting money at $3,500 gold. And that's where I think we're going. But I don't think the market believes that. And that's why I think the stocks, what will happen if this is the way it's worked in past markets, and I've been in this few cycles and watched it historically, is there'll come a moment of recognition and then they'll make up for lost time. So I fully expect, you know, my fund this year is up about 40%. I mean, you know, if that moment of recognition occurs next year, and looking back historically, I mean, my fund could go up 100% in a year. I mean, because they're so undervalued right now. But I know that for people watching this and listening, it's really annoying and it's really painful, and you've got to be really patient. And I'm as angry as anybody about it that it's taking this long. But it's like, I'm not selling. I mean, I want to see the next card, you know, and I'm pretty sure. I mean, based on historical recognition of patterns and studying everything else, I'm pretty sure the next couple of years are going to be good for us. I'm pretty sure.
At the moment, gold and silver prices show a mix of consolidation and potential for future gains. Gold is currently trading above $2,660 per ounce, reflecting a cautious market sentiment after facing resistance near $2,655, with support levels at $2,633 and $2,572. Market participants are closely watching Federal Reserve signals, particularly regarding expected rate cuts, which could influence the metal's trajectory. On the technical side, gold's momentum indicators suggest a balanced outlook, with no immediate breakout in sight unless critical resistance levels above $2,676 are breached. Silver, on the other hand, has demonstrated relative strength, trading above $31 per ounce. Analysts see potential for silver to climb toward $32 if it maintains its position above key support levels. Its upward momentum is partly supported by a favorable gold-to-silver ratio and stronger industrial demand. The broader outlook for precious metals remains bullish for 2024, with analysts predicting further price gains for both metals by year-end if global economic uncertainties persist. Rising sovereign debt concerns, geopolitical tensions, and potential policy shifts in major economies are likely to continue driving safe haven demand for both metals in the long term. These dynamics are accompanied by a weakening US dollar and expectations for reduced interest rates, both of which support precious metals prices. Please share your thoughts on Lepard's predictions for gold and the US economy in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.